Good afternoon. This is Jim Riggio. Today is the 15th of September. We're doing our weekly market review. We have a couple of guests with us. One of them is my trading partner, former Goldman Sachs partner. His name is Ian Scott. I asked him to come on. We only have about five or 10 minutes with him because I had been asked if we were going to participate in the Alibaba IPO on Friday. We've been doing so since mid-July. What we looked at, what Ian did the research on, was who were the owners of Alibaba besides Jack Ma. And upon doing that, Ian, why don't I turn it over to you about how you ended up taking a look at Yahoo and the valuation process you went through?
Yeah, I just saw a nice opportunity here to maybe buy some call spreads into an IPO, and I feel like that's normally an unusual and non-tradable event because obviously, the IPO will happen and there'll be some time period before options will be listed. Yahoo presented a nice opportunity to trade, or I believe to trade the Alibaba IPO, because the core business of Yahoo is basically worthless, or so the market prices it, and they've got this 22.4% stake in Alibaba, which is the lion's share of the market cap as represented today, along with a $9 billion stake in Yahoo Japan, which is a publicly traded company in Japan. And basically what I did was I put together a valuation spreadsheet pre and post tax for Yahoo, and with them just increasing the IPO range now, looks like the IPO valuation for Alibaba will be about $175 billion, and that'll bring in Yahoo about $7 billion in cash. Additionally, they'll retain a 16.3% stake in Alibaba post the IPO, and I figured about a 15% pop on day one, gave it a $200 billion valuation. I think that's conservative. I actually think we'll see a higher price from Alibaba on the IPO. I think a lot of times when these IPOs come, obviously no one can sell these short, and you often see large up moves on the first day. I think people will be excited about this particular IPO. And that basically brought me to a way to trade it, which has been Yahoo. And starting in about July, Jim and I began accumulating calls in Yahoo, and we still hold a lot of those calls. I actually did close out some of those today because I saw some weakness in the stock. Might be a nice opportunity with the weakness, though, to put on some additional call spreads tomorrow morning, especially if they push the stock down a little further, as I believe going into the end of the week and after the IPO, you're really going to see a pop in Yahoo. Basically, Yahoo, as I price it right now, has a valuation post-U.S. tax, which obviously we all know the U.S. tax rate is quite high, of about $40 a share. And then recently there's been speculation of a foreign buyer coming in to buy Yahoo. And if they do, they obviously avoid that 35% tax. And then you get an intrinsic value of Yahoo at $54 a share. Obviously, that's a much more enticing number if I'm long the stock at here at 42.55 went out today. And then I've
Here's
been
the
speaking.
interesting part, Ian. You talked about the valuation, three components: Yahoo's business itself, their ownership in Yahoo Japan, and their ownership in Alibaba. What valuation are you giving their core business?
I'm giving the Yahoo cash. They had a cash on their balance at the last earnings report of $2.7 billion. I am valuing the core business at $3 billion. You got that valuation from the corresponding value in AOL, which has similar revenues, similar declining growth, but they do generate a lot of cash, and AOL, I believe, has a valuation just around that $3 billion number. So I am assuming the $2.7 billion in cash on the books, a $3 billion for the core business in my calculation to get to the 39.69 post-tax number and the 54.28 non-tax number.
Okay. So it's not like you didn't end up going out and giving it any valuation. You just took standard middle of the road book value almost of theirs.
I tried to be as conservative as possible with the valuation. I mean, I feel like Yahoo, core business with declining revenues, I understand that people think it's not a valuable asset, but an asset that throws off a few $100 million in free cash a year has to be worth something. Like I said, I used the AOL and I went off and got the $3 billion valuation. You can make the argument it's $2 billion, maybe even $1 billion. Yahoo's float right now is 1 billion shares, so it's real easy to just shave $2 billion off that valuation if someone doesn't like it, and then you'd have 37.69 as a post-tax number and 52.28 as a non-U.S. tax number. And when I saw this, when I started to put this trade on, Yahoo was trading around $35, $36. They had a bad earnings report. The stock got hit down to 32. I continued to accumulate the position, and then I came to Jim and said, "What's the best way to trade this from a vol standpoint?" And I think, Jim, why don't you take over and show some of those skews and what we looked at and how we ended up in the different positions we did.
Okay. Ian, listen, thank you very much. Please comment for as long as you can stay on. I know you have another appointment, and I really appreciate you giving us a little bit of time to take us through the evaluation. What ended up happening when Ian first came to me is that we took a look at it, and the IPO date they weren't sure of. There was going to end up being a range, and they were going to actually try to do the IPO at some time in August, and it got pushed a couple of times. And one of the things that we ended up doing is that a lot of times when you're that far, 2 months in front of an IPO date, a month and a half in front of an IPO date, the IPO date isn't specifically set. Because this thing was going to be so big, there was a reasonable chance that they slip what they're talking about, the rumors of their range of where they're going to try to end up doing it, they slip it back a week or two. So what we ended up doing was the following. And I'll start with this. We both started accumulating October, not September. We weren't trying to cut it, too short. We wanted to have, at the time, remember, it's supposed to come out mid-August. We wanted to have at least 2 months of float between when they said it was going to happen and when we were actually buying. Unlike earnings, where you kind of know where it's going to end up being, here we were able to actually end up saying, "You're not sure, so let's give us a little bit more time." Has anybody ever ended up, buying, let's say, a call or a put for earnings, and then what they end up doing is that they slip their earnings date by a few days, and it goes behind the date of your option? What happens to the implied volatility? I mean, it all gets sucked out. Now, knowing that that was a possibility, what we ended up doing is that we bought October options, and what I was doing, I consistently sold. I was selling options. I bought 40s and 45s in October, and then I constantly sold earlier options. And here, I'll end up showing you my trade here that I have here. Let me import. And this is in a fund that I help manage. Okay. So you can see here what I did was that these were the 40 and 45s that I had originally bought, and I've sold Julys against them. I've sold multiple Septembers against them. The best sale, by the way, was when they ended up coming out with the target range in October. I sold for the Friday, of the week that they were coming out, and they were coming out midweek. Then when they slipped it, all of the vol came out of this. I tried to end up doing this again, with the Septembers. You see I have options here that are sold on Friday, but they never slipped it. If they would have slipped it, the vols would have come out of that, and then I would have ended up. This does not end up including any of the options that I've sold. Okay, so this is not any of my P&L. And this is what my P&L graph looks like. For those of you not familiar, the white line is current, and the red line is at expiration, which means after Friday. So depending on what ends up happening, we'll end up taking a look at the implied volatilities on this thing on Thursday afternoon. We've been watching up the entire time. Here's where I love, how I end up judging a trade. What you're looking at here. Oh, not Tesla. We don't want Tesla. That was what we were looking at before. Okay, here's the Yahoo, implied volatility skew curve for 25% above, 25% below the money. If I go out to 50% above and below the money, it just gets a little bit steeper. So what you're looking at is the date is on the left-hand side. The y-axis is the IV percentage, and the x-axis are the strike prices. So if I hold my cursor over here, I can see that this strike is the implied volatility for, sorry, there you go. The implied volatility for the 41.5 output. You can end up seeing what any of them are because this is an abnormal skew curve, meaning that the implied volatilities are call-based, that the implied volatilities get higher as we go up. It makes a lot of sense for anybody who's still looking to end up playing this to end up buying a call spread where I'm buying a call lower below the money and then selling above it. What we ended up doing, Ian and I, and I'm not sure if he's still on the phone, we ended up doing this last week, okay, when the
I
market
am still
showed
here,
up.
Jim.
Okay. What day did we end up doing the vertical?
I want to say Thursday.
Yeah, I thought it was Thursday also. I don't have my notes here. So what we ended up doing on Thursday was we ended up buying, and here's just a small little trade that I had put on in another account, okay, as I modeled. What we ended up doing is we bought the 40, sold the 44s, and the reason we ended up doing that was that the implied volatility was just so high that I wanted to buy a lower implied volatility and sell a higher implied volatility. So if you end up taking a look at what that ended up looking like, buying a 40 implied volatility, and I think I might be there, this one, right? So I'm buying the implied volatility here at 87, and then I was selling the one up here at 97. When we ended up actually doing it, I remember there was like an 11.5, almost a 12-point difference between the implied volatility. I'm buying a lower vol, selling a higher vol, going in the direction that I want. So I was very, very pleased with the way the implied volatility had. What I ended up doing was that in order to sell more stuff above the money, I actually put a second trade on, a butterfly above the money, and then when you look at them together, that's what the trade looks like. So what it's playing for is that as the market ends up running up with Yahoo going into the IPO, if we end up coming anywhere around here, remember this is Friday, so we're going to get an absolute vol crush on Friday. So what I'll end up doing is probably trying to close this trade Friday morning once the market opens, but before
Alibaba
the
trades.
IPO, before it actually trades. The vols will, once they start to end up getting a range and they start to end up announcing it, that it looks like it's going to be within this range, the implied volatilities will come out of this thing.
And that would be the range, obviously, that would be obviously the range that the specialists will begin to put out before they open the IPO on the NYSE on Friday morning. If it, let's say the range now is 66 to 68, assume they price at the high end of 68, you'll see the specialists 70 to 72, 72 to 74, 74 to 76 begin to put a range for the opening print. We're of the belief that will be higher and that you'll see immediate shocks in the vol and the price in Yahoo on Friday morning as those ranges come out.
Right, and Ian has built a spreadsheet, so as we end up seeing the ranges, what they're going to price it for, we'll keep the ranges in the spreadsheet, and then that'll end up translating to what the value of Yahoo should end up trading at, both pre and post tax of what they're going to be collecting. So we feel pretty good about it. But the biggest thing that I wanted to end up talking about this is that I got asked on Sunday from another retail trader that I speak to once in a while about how was I planning on trading the Alibaba IPO. And the answer for E and I is we plan on having our trade close and watching as spectators. Our money is going to already be made, right? The easy money in a lot of ways was already made. When you end up taking a look at, let me show you stuff that Ian has in one of the accounts that he ends up running. Right. I'm sorry. This is one of the accounts that I end up running, not including some of the calls that I've sold. So I mean, I love where I am right now. Here's the other thing: as we get closer, implied volatilities go up. So when we're buying the back months that were kept going, our October that we bought. Yes, we made a lot of money on deltas, but we also made money on implied volatility because we bought them early enough that we knew that the event was going to end up coming, and the event is almost like an earnings event. As we got closer, we knew the implied volatility was going to go up, but unlike an earnings, the excitement of it can really end up lasting, weeks on it. So we didn't think that those Octobers would end up getting a vol crush like the ones that expire that afternoon would end up getting. So all in all,
Alibaba officially raised the IPO price range to $66 to $68 a share as rumored.
Okay, and here's what ended up happening right afterwards. Okay, it moved up a little bit. And I'll show you just a couple of things. Like, for example, if I end up showing you Ian's position, okay, that he ended up having on, okay, this was basically the position he had on. He was long the 40 Octobers. Unlike me as an options trader, like it's against my religion, okay, to end up, buying something naked long or naked short. I always say if I buy something, I always have to sell against it. He held these things. At times, I looked smart, okay. At other times, he looked much smarter because the stuff just kept going up and up and up. The verticals that we put on also ended up looking real good. And so when we talked about what to end up trading against this, what we took a look at this morning is that we said the 50 calls for next Friday were going for 79 cents. So, I take a look at this, you're giving up a little bit of the upside. The vols are going to get hurt in that because you only have 7 days to after the IPO. And so to collect that much money up front made so much sense. If you take a look at what happened during the day, right? You're looking at a 1-minute chart on a Yahoo for the day here. So they were sold for 79 cents early in the morning. As it tanked during the day, the trader in Ian couldn't be helped, and he saw a quick profit to be able to take on that, and he took it. What did you buy him back for after selling him for 79 cents?
51 cents.
Right, beautiful trade, and if it pops tomorrow, he'll get a chance to sell him again.
Yeah, that was my hope. And I would just make one point because then I've got to step off, and that's I know a lot of people ask about the Alibaba IPO and can they participate in the kind of returns that they would expect even if you get in on the IPO price and you sell at the high of the day. I still think that you're going to see a better risk-reward ratio in some of these call spreads, like the 40-44 call spread that Jim and I both have on is trading at around $2. If you get a little pullback tomorrow in Yahoo and you can get that on for under $2, I think I like that trade because your risk-reward ratio should be about 50-50, and I think you've got a pretty good chance at landing in the money because I think that Yahoo should trade higher than 44, assuming obviously that, I'm making the assumption that the Alibaba IPO is going to be a success. If you're going to enter into this trade, you have to believe that the trade is going to be a success. If you think it's going to be a flop like Facebook, this is definitely not the trade for you.
And this is the trade that he was just talking about. Hey, Tony, you know what we call what Ian just did? He's talking his book. Right. We both have this trade on. It is a good trade. The other day on Thursday when we had that small pullback, I took a look at it. I thought it was a very reasonable trade. Okay, just a smaller size, right? Risking let's call it $3,500 to make $6,500, right? And we thought that we had a pretty reasonable chance to end up making that
better than 50-50.
Better than 50-50. Right? So if I can end up getting a better than 50-50 chance to end up putting on a trade, and I have to risk one to make two, that's a great trade. Those are the types of trades that aren't our core trades that we run our business on. But when these opportunities have you have better than 50-50 and it pays 2 to 1, how do you not take that? Anyway, any questions for Ian before he goes? Because we've already kept him over, and I know he's got to get to his next meeting.
I have one question for Ian. This is Tony. So basically, using Yahoo as the surrogate, makes a ton of sense. But is the reason that you picked Yahoo as your surrogate trade for Alibaba, is that because of Yahoo's involvement with them versus other companies that might, be similar in the space? I mean, is it because they're intimately involved together, like you said?
It's the ownership. It's the straight ownership. Yahoo owns 22.4% of Alibaba. Jerry Yang, the previous CEO of Yahoo, aside from destroying his company, made one extremely great successful trade, where for $1 billion he bought 40% of Alibaba. There were some transactions where they sold some back to Alibaba a few years ago, but Yahoo actually owns 22.4% of Alibaba. So if a $200 billion valuation of Alibaba, you're looking at a price of almost $45 billion in Yahoo's stake, and at $1 billion a share, it's $45 a share standing on its own. That's why I chose Yahoo. Yahoo owns 24% of Alibaba. SoftBank, the big Japanese company, Masasan, owns about 50%. Why I chose Yahoo and not SoftBank trying to get the ownership of Alibaba was the balance sheet in Yahoo is a little cleaner. It's really just Alibaba. SoftBank owns Sprint. They own some other stocks, and that maybe would be a little bit more difficult for me to value. I chose Yahoo because the lion's share of their valuation is in this ownership that they have in Alibaba. So it's not a business relationship. It's actually an ownership. They'll profit from the IPO, selling a prearranged stake of about $7 billion post-tax in cash for Yahoo. And then after that, they'll have about 16% of the remaining stake in Alibaba. So if you're watching Alibaba trade after, and you can see the valuation of Alibaba, it'll be very easy to translate. Just take 16% of that, and that's the ownership that Yahoo will actually have.
Makes total sense.
Yeah.
Okay. Thank you very much. Ian, I knew you need to get going, and go ahead, get going. The thing I'd end up adding is that I had looked at this. I had mentioned to Ian. I looked at the ownership of SoftBank, and I said, what happens if I end up buying SoftBank, which is only listed, it's not listed in the U.S. You have to end up buying it overseas. And then I go and I short in a percentage as many of the other holdings within SoftBank as I could. And it was just it was a little bit messier transaction, didn't give me the risk-reward ratios that I wanted. By the way, for their private clients, and I forgot which bank it was either Goldman or it could have been Morgan Stanley or JP Morgan. One of them ended up offering this service to their clients where they would end up buying it as a bundle, buy SoftBank, short everything that they could else that SoftBank owned. This gave us a lot better risk management on the downside if things didn't work.
And a lot better liquidity. Yahoo traded 71 million shares today. You're getting great liquidity in Yahoo. That I think SoftBank actually does have an ADS or an ADR of the trades, but it's not going to trade anywhere near the volume of the Yahoo calls, puts, or the underlying equity.
So, Ian, thank you so much.
I'm going to step
off. Really appreciate it.
Guys.
Get going to your meeting.
Good luck trading and make a lot of money.
Thanks, Ian.
Take care. Bye.
Okay, guys. I wanted you to end up hearing that I've been trading with Ian for maybe about 6 months or so. Ian's background, okay, which we didn't have time to end up going through, is that he originally was with Spear Leagues Kellogg, was a trader with them, and when Goldman bought Spear Leagues, he became a trader with Goldman, was there for a whole bunch of years, and then ended up moving down to Florida, actually works out of Fort Lauderdale, and ends up investing for closely held, which just means private clients only, a group out of Fort Lauderdale. And we've been working together to try to end up combining what we end up doing because there's a lot of synergies. As you saw what he ended up doing going through the evaluations in the range, he would normally end up playing things with just individual stocks. What he trades is actually extremely interesting, an ETF arbitrage where he might buy an ETF and sell the components. The challenge is that the high-frequency guys have really put a huge crimp in his main business, and he trades it both pre- and post-market when the high-frequency guys aren't there. But as he looks for more of these trades, the risk-reward ratios that the options market and the implied volatilities, which I kind of specialize in, end up just being a great fit for these types of plays. That being said, before we get to our regularly scheduled program, any other questions just about the approach? I know we went really fast, but we had a number of people asking us, and it really is quite an interesting play because you guys have all heard the old expression, buy the rumor, sell the news. We bought, I always think the great traders are getting out of the trade while the hype is at its frenzy. You know, I make fun of Ian because he likes to end up making fun of CNBC, and he has it on in his office. But by the time they're announcing things today was the very first time I heard on either Bloomberg or CNBC sources about why Yahoo has been up so much in the general news. Yeah, there might be little, segments in here, but as they were doing their movers on the day early on, they brought it up. It was the first time I had heard it. And as you see, we're getting ready to, map out our exit strategy by the end of the week.